Finovate showcases cutting-edge banking and financial technology through a global conference series featuring short-form demos and thought leadership. Now, the conversation continues on the Finovate podcast.
Hi, everybody, and welcome to the Finovate podcast. Joining me today, we have Laura Kornhauser, CEO and co-founder at Stratyfy. Stratyfy, another of the Best of Show winning companies from FinovateFall back in September. Laura, thank you so much for taking some time to be here with me today.
Thanks so much for having me, Greg.
Excellent. So to kick things off, just tell us a little bit about yourself and Stratyfy, where you guys are coming from.
Absolutely. So my background is in financial services. So prior to starting Stratyfy, I spent over a decade at JP Morgan in lending and risk roles. During my time there, I noticed that there was a tremendous amount of opportunity at the intersection of finance technology, and especially for regulated use cases, and decided to make the big leap to go out and search for my co-founders and find Stratyfy. What we do at Stratyfy is we help credit and risk teams better assess risk through what we say is real transparency. We also have a real focus on driving greater financial inclusion and doing that by helping financial institutions provide greater access to fairly priced financial products to a wider group of individuals than historically have had that access in the past.
Yeah, no, it's a really cool message, a cool product. And I would encourage anybody listening to check out their video at finovate.com, where you can see the full 7 minutes of what Laura demoed up there on stage. Before we jump into the product a little bit more, I'm just curious, how did you decide that this kind of credit lending space was an area that you really wanted to get involved with?
So great question, Greg. So what really brought us to this space was actually personal experiences that me and my co-founder had, where we both were actually denied of credit products, and we didn't think those decisions were fair or were the right decisions. And when we actually drilled down deeper into why we had been denied for those credit products, we found that it was because of effectively one bad indicator on our record that we really didn't think should be an indicator of our ability or willingness to pay in the future. I actually went so far because I was rejected for a credit product by my former institution that I worked for over a decade, Chase. I went so far as to call the number on the back of the letter and dig into why I was rejected and actually be able to get that decision overturned. But not everybody, I would say, has the stubbornness to do that. So for us, it really exposed us to this space where financial institutions are missing out on some really great customers and some really great opportunities by looking at individuals, looking at borrowers in an overly rigid, or I'll say two-dimensional way. And that's really what we're here to help them solve.
Yeah, well, you touched on something there that I think really was a central piece of your demo on stage, the idea of how much we are losing from a GDP standpoint, because we are beholden to a credit risk decisioning model, which quite frankly has a lot of flaws in it. And this is leaving a lot of opportunity on the table. Obviously, a lot of people frustrated, like the experience that you had. And I think you had the stat that $13 trillion of GDP had been lost since the year 2000, which is just mind-boggling. Yeah. Can you unpack that a little bit and just give us some background on where that number comes from?
Yeah, absolutely. So that number is actually from a report that Citigroup put out in the year 2020 on the racial inequality that exists in our country, and what the impact of that gap is on our GDP. So that's where that number comes from. And really what that is lost productivity, lost economic opportunity that is a result of these lending decisions that fundamentally leave certain people out and systematically leave certain people out of our financial system, which then means that those folks can't build wealth for themselves, for their communities, for their families. And that's, both those that are discriminated against for individual loan products, so for consumer loan products, but also for small business loans. And that's really an opportunity that we're helping our customers, lenders go after and really mitigate.
Yeah, and I think it's obviously there's a couple different pieces here. There's the idea that there are specific groups of people who have been, unfairly left behind. There's also this kind of ripple effect idea that, in some cases, the right loan for the right individual or the right business can have this really outsized potential knock-on effect of, allowing somebody to really take control of their financial future in a way that just isn't possible without access to credit. Now, I want to talk about this because you kind of talked about the idea of bias in banking and bias in the lending process. And I think it's really important that we kind of clarify what exactly you're talking about here, because are you looking at this from the standpoint of systemic biases kind of baked into the system, or individual bad actors who are acting in a biased way, or is it a combination of both?
Yeah. So really, the way we're looking at this is more focused on those systemic biases or systemic inequalities that are really baked into our financial system, and they're baked in because there have been so many bias policies, bias individuals, just structural biases that have been part of our financial system and lending in particular for decades. So while I think today, sure, are there bad actors out there? Obviously, there still are, but I don't really think that that's what's driving the majority of the inequality that we're seeing. I think it's what's baked into the system, and because it's baked into the system, it's also baked into the data that we have and the data that we have about individuals. So, another great stat I think to mention here is that 80% of individuals have never defaulted on a loan, but less than 50% of individuals have access to prime credit. That's a stat across Americans. So just think about that for a second. Folks, 80% of folks, are good borrowers, would always repay their debt. But if you will, the data that we have about them to indicate whether or not they are a good borrower, their credit score indicates that they are not a good borrower. So that data is just fundamentally wrong, or said another way, it's fundamentally biased. And as we are more and more using the historical data that we have about individuals to drive more automation in the decisions that we make that truly impact their future, which, providing access to credit is, as you mentioned, Greg, a decision that truly impacts someone's future. As we're using that data more and more, with more powerful models, et cetera, it is so important that we are proactively searching out the ways in which that data is biased so that we can do something to address it, so that we can take proactive action to ensure that we are not encoding the biases of the past into the decisions of the future.
Yeah, well, I think one important thing to note here that you really didn't talk about is the idea that it's not anybody's fault necessarily. And I think people sometimes hear this phrase, where there's bias in the system, and it can feel like it's a judgment value, a value decision based on me as a person. You're saying, well, you are acting with bias, and that can be something which kind of instantly puts people on the defensive, which people take, I think, probably justifiably as assault on their character. But what we're talking about here is not really about this individual level, and I think when people hear about bias in lending, recognizing that this is a structural problem, this is an overarching problem. And to your point earlier, it's just not correct. The data is not giving you an accurate perception of who is likely to repay a loan and who is not. And so I know the word bias can be sometimes a little bit off-putting, but at the same time, recognizing in this context, I think is really important.
Yeah, we see that happen out there, Greg. And if anything, the individuals that we come into contact with are the exact opposite of that, right? They're folks that are proactively looking to make a change, proactively looking to take action, to again try to address these systemic issues, these issues that are baked into the system that most of us inherited, right? Like that most of us were not the architects behind the current system in place today, right? We inherited it. So we actually see that the individual actors are the ones that are trying to actually take proactive stance, proactive action to change things, which we find really inspiring. And that's the work we're doing is to try to help them do that, to try to give them the tools and technologies to enable them to do that, and enable them to do that at scale, because this is a hard problem, right? Yeah. It's a hard problem to solve. It's a hard problem to address, right? It's one that requires it, as I joke, it's not a set it and forget it issue, right? So it's not something that I can say, okay, I looked at this, I checked, and and saw, hey, my model's not biased today, so that means it's going to be fine tomorrow. It's just not the way it works, right? Because then you put that model out in the wild, and it experiences different things than how you may have built it or how you may have tested that. And that's not because whoever built the model did something wrong. That's just the way of the world, right? So
Yeah.
I think what folks really need is they need tools and they need technologies that enables them to take this more proactive stance, because they want to be addressing these issues, and they want to be doing more to ensure that these hard issues are solved.
Yeah, well, and I think there's always going to be, to your point, more and more technology available, more data available. We can continue to just get better and better at this. I suppose we've been slightly remiss in that we haven't actually talked too much about what Stratyfy does, how you're specifically able to, fight against this in a way where other people haven't been able to. Could you talk a little bit about, what's kind of underneath the hood, so to speak?
Absolutely. So our unbiased product that we demoed at Finovate has really three key components. Those key components are focused on first helping uncover bias in models and decisions and lending decisions. So helping uncover fair lending risks, so that folks can start to actually do something about it. The next piece is understand. That's number two. So if I have a risk, how do I understand what is actually driving it? If I understand what's actually driving it, if I have visibility that helps me know what's behind the bias risk that is present now, then I can do the third piece, which is the critically important and ultimately the hardest piece to do, but a place that we feel we have a real competitive differentiation is in the undo piece. So, now I see a risk, I know what's driving it. How do I actually take proactive action to mitigate that bias from my model, from my decisions going forward? What enables all of this for us, what enables us to be able to do this and do it in a way that we see as truly differentiated versus others available in the market, is a core modeling technology that we've developed over the last decade plus that basically enables our users to get the benefits as typically associated with machine learning. Those benefits are automatic extraction of insights from data, easily updated and rebuilt models at scale, ability to deploy these models dynamically into production for automated decisions, but do all of that in a way that it provides just orders of magnitude differing levels of transparency or visibility into how the heck the model is actually working. So that is the huge piece that we think we do better than anybody else out there. We're not building a black box model and then adding post hoc explainers that kind of sort of tell you how the model is working. We actually show you, if you will, the guts of the model and exactly how the model is working. What that means is you can then change it, right? So that's important, right? So that's important for a variety of reasons, right? But it's really important around this area of bias, because as we have been talking about, right, even the best model trained on some, heaps and heaps of great data is going to propagate forward the bias that is inherent in that data. And I always say it's not a question of if your data is biased, it's a question of how. So you need this visibility, the visibility we provide, and the control to be able to change how the model is working, to be able to actually address the bias that is embedded in your data.
Even just listening to the way you talk about it, the idea of kind of getting past this black box, I think you understand the difference, because basically that's how credit decisioning is right now. It goes into a big black box. You can't see what happens. And this is sort of what we've all been conditioned to expect. The idea that this sort of arbiter, this decider, will just sort of say yes, no, thumbs up, thumbs down. And it is really difficult to get in there and make any kind of adjustment to it. The idea that it needs to be a living, breathing, ecosystem is something which I think is really important. And again, as we move forward, there's only going to be more and more pieces which we can add to it to continue to get to that, idealized, fair reporting system, fair decision-making system. So obviously, you did well up on the Finovate stage. The audience responded really well to what you were saying up there. What has been the feedback from financial institutions that you've been getting so far? Do you see at this point a push of people kind of recognizing that there's more to be done here? Is there maybe an impetus to actually change things here?
Yeah, so we're receiving a tremendous response from Finovate, that's for sure, and that was both in person at the conference and thankfully has really continued post conference as well with the follow ups and the inbounds that we've been getting, which has been really really wonderful. What we're seeing is one, a real demand for a solution like this, a solution like Unbiased that, again, as I mentioned before, right, recognizes that this is a hard problem to solve, but looks to present that solution to the user in a way that is, hopefully very intuitive, easy to work with, easy to follow, easy to track, easy to report. All of these kinds of things has really resonated really well with the audience. And what we've seen from financial institutions is that they want to be taking a more proactive stance in this area of fair lending risk in particular, and that they understand that there is a real revenue opportunity for them in doing this. There's an obvious risk reduction piece, right? The risk reduction piece is clear, right? My compliance department's going to be super happy. Should a regulator ever come knocking, I'm going to have some great things to show them. It's going to help me with internal audit. All that kind of risk reduction piece is kind of the first piece that really resonates in their mind. But what I'm excited about, that we're in the early innings of, but we're seeing it from folks, is this understanding or this recognition that if I can be saying yes to that incremental borrower that previously I said no to, right? And I can do it in a way that shows me, hey, that increment like picks out going to my 80%, have never defaulted on credit, yet 50% have access to prime credit, right? If I can find that 30%, right, there are tremendous revenue opportunities for me, right? If I can be that lender that's saying yes when everybody else is saying no, that is very good for my bottom line. So that recognition, again, mentioned, we're kind of in the early innings of it, but we're seeing it. And that's, I would say, the piece we're really excited about, because we expected the risk reduced piece.
Sure.
But the understand the revenue opportunity piece is I think really exciting and really promising.
Yeah, no, I think you're absolutely right there. And if you look at what that 30% means in terms of real numbers, like actual human beings who will turn into potential customers. And then again, the ripple effect of what happens to each of those human beings in their own communities and their own families, who are all of a sudden now able to take a much greater control over their financial futures. You start to really see the scope of what we're playing for. Yeah. Right. Yeah, now all of a sudden that 13 trillion right? number, maybe, you can imagine, here's how you got to it. We have time for one more question. And I just want to close by kind of asking, what do you see, if you take a couple of steps way back, what do you see as the biggest hurdle that we need to overcome in this industry in order to get to a place where we can actually eliminate bias in banking, or maybe not eliminate it altogether, but get it down to at least something approaching an acceptable level?
Yeah, it's a great question. And again, I think more, I always use the term mitigation, because I think, elimination would be great, but it can assume that like we get to this place and then we get to stop working on it. Right. I think that's not realistic, right? It's going to have to be, it's kind of cyclical. And again, it's not a set it and forget it thing. But, how do we get to the mitigation piece? One, it's going to a lot of the points that you brought up today, Greg, right? Of kind of taking that proactive stance and having financial institutions take that proactive stance to not feel attacked when dealing with these issues of fairness or bias detection and mitigation, to recognize that it's not an individual's fault. It's not one person's fault. It's not, someone's a bad person. And that's the reason that this is happening. It's ingrained in our system. It's ingrained in our data. So first, that's kind of the first piece that I think we've made a lot of progress on. We still have a little bit more to make so that people don't feel kind of attacked when these issues are brought up or potential solutions are posed. And then, the next thing, and this is probably the bigger hurdle, is this ability to really not just understand how data is being used to make decisions, right? That's really one important piece of the transparency side. So understand how data is fueling decisions, but then be able to change it.
Yeah.
And I think that that's the piece that is forgotten sometimes in these talks of transparency, right? We all know black box is bad. So now everybody claims that they have transparency, right? Like, just sprinkle some transparency on it. But when you actually dig down into it and you say, okay, transparent to whom, right? Like who can actually understand this? And then, if you can actually understand it, how easy is it for you to change it, right? And change the system, right? And use, one of our taglines is where AI meets IQ, right? Use the data, right? Get information from the data, but then also allow humans to override it in certain places and correct it, which is so important in the areas of bias as well. So having that kind of differing level of visibility or transparency such that you can not just see how things are working, but actually make a change, I think is the hardest piece right now, that we really think we have a real significant role to play in providing for financial institutions such that they can do it.
Yeah, no, I mean, I think it's awesome to hear you talk about the way you guys are approaching things, because there's a lot that just makes so much kind of intuitive sense. And when you look at the size of the opportunity, you look at the real concrete need, not just for the end customers, but for the financial institutions that serve them. As we look forward and you look at the next 5 or 10 years, there's going to be major changes to the way the financial services industry operates and the way that it serves its customers. And I think this is one of those areas where people who can figure this out, and I think, to your point again, there's a long way to go. We kind of talk about at the end, there's the complexity of the problem is obviously immense, but there's so much good that can come from it that it's not difficult at all to see why your message resonated so well with our audience and why you were able to leave the show with a trophy in hand. So we'll have to leave it there. But I really appreciate the time that you took chatting with us. Congratulations again on that Best of Show win, and all the best as you look to take this into the level that it has to be taken to in order to be successful.
Thank you so much, Greg, and thank you for this opportunity. Love chatting with you.
The Finovate podcast is produced by Informa Connect in association with Provoke.fm Media. Check out Finovate.com for information on Finovate's upcoming shows and to learn how you can get involved. The discount code Finovate Podcast will save you 20% on tickets to all of our events. And you can email us at info@finovate.com for information on sponsoring, speaking, or demoing. Thanks for listening.